Have you ever looked at a stock chart and just seen, well, chaos? A jumble of lines zigzagging up and down with what seems like no rhyme or reason at all? Today, we're going to tame that chaos. We're going to dive into some of the most fundamental tools and technical analysis that help traders actually see the story that's hidden inside all that price action. And that's really the big question, isn't it? All those daily ups and downs, the little random price movements, that's what traders call noise. And all that noise makes it incredibly difficult to see the real direction, the underlying trend. Is the stock really going up? Is it going down? Or is it just stuck going sideways? So what you really need is a filter. You need a tool that can cut right through all that noise, smooth out those jarring fluctuations, and reveal the signal that's hiding underneath it all. Just think of it like trying to see a river's current. You don't want to get distracted by every little ripple on the surface. Okay, so let's jump right in with our first and honestly most foundational tool, the moving average. This thing is the bedrock for so many other technical indicators, which makes it the absolute perfect place for us to start. So what exactly is it? Well, a moving average is pretty much what it sounds like. You're simply taking the average closing price of a stock over a specific period, say the last 20 days, and by plotting that average as a single smooth line on the chart, you can see the actual trend direction way more clearly. Now, here's a really important thing to get. Moving averages are lagging indicators. They don't predict the future, okay? They move a little slowly, and what they do is confirm a trend after it's already started. And as you can see here, the time period you choose makes a huge difference. A short-term average is going to hug the price really closely and react fast, but a longer-term average that gives you the big picture, slow and steady view of the trend. But, just like with anything in the markets, there's always more than one way to do things. It turns out not all averages are created equal, so let's break down the two most common types you're going to see, simple and exponential. The simple moving average, or SMA, is the most basic one. It's super straightforward. You take the closing prices for the last, let's say, 5 days. You add them all up, divide by 5, and boom, that's 1 point on your line. Tomorrow you do it again, and you get the next point. See? Simple. But that simplicity comes with a pretty big catch. And this right here is the crucial problem. Because an SMA gives equal importance to every single day in its calculation, a single wild event can throw the whole thing off. Imagine some unexpected bad news causes a one-day price collapse. That one day can distort the entire average and give you a totally false signal. It might make it look like a new downtrend is starting when in reality, it was just a one-off event. So, how do we get around that? We need a smarter average. We need one that understands that what happened today is probably way more important than what happened 20 days ago. The key is to give more weight to the most recent price action. And that is exactly what the exponential moving average, or EMA, does. It puts more emphasis on what traders are doing right now. And because of that, the EMA reacts much more quickly to recent price changes, which, as you can imagine, can be a massive advantage. So, which one should you use? Well, there's no single right answer. It really depends on your trading style. If you want a really smooth line to see the long-term trend and you want to avoid getting faked out by short-term noise, the SMA is going to be your friend. But if you're trying to catch trends as early as possible and you're willing to deal with a few more false alarms, then the EMA is probably your go-to. All right, so we've got our trend line. What can we do with it? Well, we can actually build right on top of it. One of the simplest but also really effective ways to do this is by creating a channel or an envelope that basically wraps around our moving average. The idea here is really simple, but it's powerful. You take your moving average line and then you plot two new lines. One that's a set percentage above it and another that's the same percentage below it. Together, these three lines form a channel that contains the price most of the time. You can think of it as defining the normal trading range around the trend. And this right here shows a super basic trading strategy using these envelopes. The theory goes like this. When the price breaks out of this normal channel, like when it closes above that upper band, it signals really strong buying pressure. And on the flip side, When the price closes below the lower band, it suggests significant selling pressure. It's a simple visual cue for a potential change in momentum. Okay, but what if we could make that channel dynamic? What if the channel could actually expand and contract based on how volatile the market is at that moment? Well, for that, we turn to one of the most popular indicators out there, Bollinger Bands. This tool helps us measure if the market is quiet or if it's getting really loud. So Bollinger Bands have 3 lines. The middle line is just a good old simple moving average, but the outer bands are calculated using something called standard deviation. Now, don't let that scare you. It's just a way to measure how spread out prices are. When the bands expand, it means volatility is high and prices are wild. When they contract, things are calm. And here's the magic number. By setting the bands to standard deviations away from the middle, they'll contain about 95% of all the price action. So, what does that 95% number mean for us? Well, it leads to our first key concept, the Bollinger Bounce. Because the price spends so much of its time inside the bands, the outer bands often act like dynamic guardrails, like support and resistance. It's really common to see the price touch an outer band and then bounce back toward the middle line. Now, this second concept might be even more powerful. It's called the Bollinger Squeeze. When volatility just totally dries up and the market gets super quiet, you'll see the bands contract and squeeze together really tightly. This is almost always the calm before the storm. A squeeze is a huge signal that the market is coiling up for a massive move, a breakout. The only thing is, it doesn't tell you which direction that breakout will be. So, after looking at all this stuff, moving averages, envelopes, all these bounces and squeezes, I bet you might be asking this exact question. Is this some kind of secret formula, a crystal ball for predicting what's going to happen next? And the answer is a hard no. These indicators are definitely not a crystal ball, but what they are is a much, much better lens. They don't predict the future, but they do help you understand the present with a ton more clarity. They help you read the market story by organizing all that chaotic price and volatility data into something you can actually see and understand. So here's the real takeaway. These tools don't just hand you answers. They give you a much better way to ask questions. They transform that chaotic chart into a map of probabilities. So now you have a framework to see the trend, to measure the market's mood, and to spot potential turning points. The story is right there in the data. The only question left is, what story will you see?